Before the COVID-19 pandemic, commercial real estate in the United States was thriving. In 2019, the office vacancy rate was at a low of 12%, and retail spaces were bustling with activity. Having a successful business meant that you had a fancy office downtown where your team could work and grow together. You had a shift away from the Mad Men Don Draper era of some of these large offices. Fast forward to 2024, and the landscape has dramatically changed. Office vacancy rates have soared to 19.6% of office space that isn't leased, is the highest since at least 1979, and retail vacancies have increased as well by about 5%. San Francisco, for example, went from the third lowest office vacancy rate in 1991 to now having some of the U.S.'s emptiest offices.
According to the leading firm that tracks commercial retail space, about 1/3 of the office space in San Francisco is not being used. And this just shows it's going to be a long road to recovery for downtown.
In fact, there is an exodus map that you can find online where you can see all the businesses that have left or are leaving San Francisco. According to some sources, San Francisco currently has a vacancy rate of 24%, the third highest rate among the largest U.S. office markets, outpaced only by Houston's 24.5% and Detroit's 31.3%. This is not just limited to the biggest of cities, though. According to the latest Wall Street Journal article, cities such as St. Louis are also struggling. The office district is empty, with boarded-up towers, copper thieves, and falling retail. Even the Panera outlet shut down. The city is desperately trying to reverse the doom loop. And I realize that many folks might not realize the Panera outlet being shut down as being a big deal, but in St. Louis, it was originally founded as the St. Louis Bread Co. It's very important to the city. Additionally, in St. Louis, many offices are empty and shops and restaurants have closed. How did we get here? And also, why are we not seeing the values of commercial real estate in Europe and Asia dropping like they are in the United States? Further, what does the future hold for commercial real estate, particularly in the office sector? Stay tuned as we dive deep into these topics and more. The COVID-19 pandemic was a turning point, accelerating a shift that had been gradually unfolding. Businesses had to adapt quickly, and remote work became the norm almost overnight. As of 2023, 12.7% of full-time employees work from home, while 28.2% work a hybrid model. Hybrid work is reflective of life in general, in my opinion. There are no easy answers, and there are going to be trade-offs regardless of which option you choose. Remote and hybrid models offer flexibility, reducing commute times and allowing employees to design their own work environments. This flexibility can lead to improved work-life balance, higher productivity, and even environmental benefits due to fewer commuters on the road. Of course, this shift isn't without its challenges. Isolation, communication barriers, and blurred boundaries between work and home life are common issues. The normalization of remote and hybrid work has significantly impacted the demand for office spaces, leading to a shift in the commercial real estate market. As more companies adopt remote and hybrid work models, the need for large, traditional office spaces has declined. Companies are reevaluating their office space requirements, leading to a decrease in demand for high-rise office buildings and sprawling corporate campuses.
It's over. We are screwed.
With the shift towards hybrid work models, there's an increased demand for flexible workspaces. Co-working spaces and shared office environments are becoming more popular as they offer the adaptability that businesses need in this new work landscape. These spaces allow companies to scale up or down based off their current needs without committing to long-term leases. As remote work allows employees to live farther from urban centers, there's an increased demand for office spaces in suburban and secondary markets. Companies are considering satellite offices or smaller hubs in these areas to accommodate employees who prefer not to commute to major cities. Personally speaking, success to me, at least as it relates to office space, would be to have an office for the team to use whenever they needed to that was centrally located within the city, as well as a single small office that I could use personally that's within 5 minutes of my house. Even having two offices in that scenario would likely be much more cost effective than having one office in the central business district. The changing dynamics of office space demand have led to fluctuations in commercial real estate values. In some urban areas, the value of office buildings has declined due to reduced demand and the increased vacancy rates. Conversely, in markets where remote work is popular, there may be increased demand for office spaces that cater to hybrid work models. The uncertainty brought about by the pandemic and the shift to remote work has led to innovations in office leasing. Shorter lease terms, flexible lease structures, and rent concessions are becoming more common as landlords and tenants navigate the changing landscape. Could this lead to the resurgence of companies such as WeWork? WeWork, which was once valued at $47 billion, eventually filed for bankruptcy. As of April 2024, Adam Neumann made a $500 million bid for WeWork that could hit $900 million to regain control of the company. The Global Co-working Growth Study 2022 predicted that the number of co-working spaces worldwide is expected to reach over 40,000 by 2024, up from 26,000 in 2021, highlighting the growing demand for flexible office solutions. We have a full in-depth video coming up on WeWork, so be sure you're subscribed to this channel so you'll be aware of when it's released. In 2022, the total investment volumes in the commercial real estate market fell by 17%. After experiencing a drastic increase in the investment value of American commercial real estate in 2021, following the effects of the pandemic in 2020, investments declined once again in 2022. It is, however, worth noting that investments dropped between approximately 1% and 41% across the various asset classes. Is private equity going to come to the rescue for commercial real estate? Mark Grennis, the leader of EY America's Real Estate, Hospitality, and Construction, believes that buildings with poor structure and financial backing may soon change hands or be foreclosed. However, when the market is favorable, private equity is expected to intervene. As public interest in office stocks grows due to their perceived value, private capital is likely to invest at the right time. This influx of capital could help stabilize the market. I just don't see private equity really being the savior, though. Sure, there will be much more capital available if private equity does decide to go after this asset class, but the bottom line is there needs to be the demand. And if you have the capital without the demand, the problem isn't solved. The future of commercial real estate in America. Opportunities. In 2024, attractive investment opportunities in commercial real estate are expected to arise due to high interest rates and an economic downturn, possibly even a mild recession, leading to lower prices for certain assets. Secondary office properties have already experienced a significant drop in prices because of increased vacancies caused by the permanent shift to remote and hybrid work. As interest rates start to decline and inflation further reduces, the refurbishment or repurposing of underperforming office buildings into other uses will become more appealing and financially feasible. This transformation will receive significantly more support from state and local governments in 2024 and beyond. Since the COVID-19 pandemic began, the U.S. commercial real estate sector has seen significant changes. The rise of e-commerce has led to increased interest from investors in industrial and logistics properties. However, the office sector has faced challenges, leading to lower investor enthusiasm. The shift to hybrid work models has forced offices to adapt to new requirements and decreased demand. Despite these changes, the U.S. commercial construction industry has been growing steadily since 2020. In 2022, the construction of commercial real estate amounted to $115 billion. That year, construction starts for warehouses reached over $27 billion, while office property starts were around $20 billion. I have some firsthand experience here because one of our portfolio companies, Southwest Steel, actually provides steel for commercial construction projects. And I'll be honest with you, we've had a pretty good run these past few years. Can AI save commercial real estate? Over half of U.S. firms are integrating AI, with benefits ranging from operations and cybersecurity to customer management and content creation. AI isn't just about job displacement, it's about automating tasks to create a more efficient workforce. While some jobs may be lost, AI is expected to create new opportunities, potentially generating 97 million new jobs globally by 2025. The North American AI market size was $176 billion in 2022, with a projected annual growth rate of 21.9%. AI's impact could extend to smart cities, where infrastructure is optimized through AI. This could impact commercial real estate, driving demand for AI-ready buildings. Historically, technological advancements like AI have driven economic recoveries, with AI poised to drive productivity gains across many different sectors. While the full impact of AI on office space is unknown, the growing presence of AI companies suggests an increase in demand. AI's ability to streamline tasks and empower teams could influence office design, creating a need for strategically designed physical workspaces in a hybrid model. Integrating AI into the hybrid workplace can catalyze flexibility, innovation, and productivity, liberating human potential for higher-order problem solving. AI-driven platforms like Ray's Commercial Real Estate's Workplace OS leverage real-time data for strategic decision-making, optimizing space utilization and tenant experiences. In an ever-evolving office landscape, embracing AI and technological advancements is essential for staying competitive. From a leasing standpoint, integrating AI into portfolio management can revolutionize decision-making, empowering clients with tailored insights. As AI evolves, expect more innovative solutions that put tenants at the forefront, creating a vibrant, data-driven real estate ecosystem. But the real question is, what will the long-term impact of AI be on jobs and the need for office space? Sure, you can make the argument that at least short-term, there's going to be increased demand as the technology is being developed. But one of the central concepts or goals of AI is to increase efficiency and thus reduce the amount of work content, thereby needing fewer workers. So even though the short-term benefit might be there, it's tough to say what's going to happen in the longer term. Can downtowns be revived? Commercial real estate goes beyond just office buildings. The downtown areas that are entire ecosystems of businesses have struggled due to the decline in commercial real estate. The supporting businesses around major office spaces, such as retail stores, restaurants, gyms, etc., have all struggled due to the fall in foot traffic. If downtown foot traffic falls by 20%, then it stands to reason that revenues for these small businesses are going to drop 20% or perhaps even more. With premium rents and out of control retail theft and crime, it begs the question, can small businesses afford to stay open? The National Retail Federation reported that more retailers in America felt organized retail crime was a higher priority in 2023, 78.1%, compared to 2022, 70.7%. In addition, shoplifting statistics show that 88% of retailers say that shoplifters are at least somewhat more aggressive and violent compared to 1 year ago.
An Orange County jewelry store was hit by several suspects. A group of up to 30 suspects ripped apart a Nordstrom store. Coordinated groups are targeting stores, millions of dollars worth of goods. Retailers say they're growing more violent, putting shoppers and workers at risk.
Washington ranks as the state most impacted by retail crime, and Wyoming is the state least impacted. The state with the highest average total value of stolen goods per capita is Pennsylvania, where the total value of stolen goods is $430 per capita. The majority of small business retailers, 79%, said their monthly losses from theft were between $500 and $2,500, and 10% said theft losses accounted for more than $2,500. To make up for losses due to theft, most retail business owners have increased prices, 64%, and/or installed security cameras, 50%. In fact, retail theft and other shrinkage factors drained $112 billion from stores last year. I know this can become a political topic, but with the double whammy of increased retail theft and crime with lower foot traffic and revenues, is this the death of the downtown as we once knew it? Outside of downtown areas, commercial real estate trends across asset classes. JP Morgan has released excellent data on many different asset classes of real estate. Some of their findings suggest that multifamily and neighborhood retail remain strong. Neighborhood retail success. Many see retail as synonymous with Class B and C malls, which haven't performed well for years. But retail also includes neighborhood shopping centers in densely populated urban and suburban areas. While e-commerce continues to grow, it only makes up about 15% of all retail. So there's plenty of room for brick and mortar operators. Retail will emerge as a stalwart in 2022, Jabir said. The asset class is expected to experience steady performance with unchanging vacancy rates and moderately positive rent growth for neighborhood and community shopping centers. The national office vacancy rate reached 19.2% in Q3 2023, according to Moody Analytics. That's up from Q2 and approaching the historic peak of 19.3%. Despite these headwinds for office, it's important to remember that while there is and will continue to be obsolete office, the office itself is not obsolete, Jabir said. With a flight to quality in reach for more office occupants, some older, less desirable Class B and C offices may face obsolescence. As a result, there could be opportunities to convert central business districts' office space into apartments or data centers. The industrial sector, particularly cold storage properties, continues to perform strongly. Efforts to reshore and nearshore manufacturing operations could further boost this sector. However, there are signs of moderation as post-pandemic demand for increased inventory decreases and renters delay expansion. Despite this, the long-term outlook for the industrial sector remains positive. Moody's Analytics CRE forecasts annual rent growth for warehouse and distribution properties to remain steady at approximately 5 to 6% per annum over the next 10 years, suggesting that the sector has reached a new stable state.
As a private equity firm, we're typically not involved in real estate. And actually, whenever we're buying a business that the owner also owns the real estate, typically we'll do a sale-leaseback as a simultaneous transaction with purchase of the business. So even though we're not real estate investors, the asset class of real estate is too large for any investor really to ignore. And for those reasons, we need to be educated in this sector just like everyone else. If you're a business owner, do you see commercial real estate in general, with office real estate in particular, being one of the key drivers for the next recession? And I know it makes my mom proud whenever I can tell her my subscriber count's going up. If you haven't subscribed already, please do. Make my mom happy. Thanks.